Welcome to the Coin Bureau Weekly News Roundup. My name is Jessica.
And my name is Guy. Here are the top stories in crypto this week.
Crypto market chop. BTC trades sideways as ETF flows stabilize, and whales position themselves for the pre-halving pump. How high could BTC go this month?
Betting on ETH. Asset managers continue pushing for spot Ethereum ETFs, while Ethereum's blockchain blobs get filled up by inscriptions. What does this mean for ETH?
Memecoin madness returns. Memecoins on Base and Solana hit new all-time highs, foreshadowing new memecoins on other chains. Where can you find the next 100x?
Oil prices on the up. The world's most important commodity starts to pump, leading to concerns that interest rates will follow. Everything you need to know.
And a closer look at last week's top-performing cryptos and where they could be headed next.
All this and more in just a moment. Last week, BTC traded almost perfectly sideways. This was likely due to a combination of the modest inflows and outflows experienced by the spot Bitcoin ETFs. For context, spot Bitcoin ETFs saw around $850 million of net inflows, which is pretty good for a 4-day week. Markets were closed on Friday. On that note, it appears that crypto whales bought a couple of $1 billion of BTC over the weekend. On-chain analysis reveals that $1.4 billion of USDC was deposited into Coinbase. Shortly afterwards, $1.1 billion of BTC was moved from Coinbase-related wallets. It's safe to assume this was a big BTC buy. Now, this buying by BTC whales makes sense when you remember that the Bitcoin halving is less than 3 weeks away. For reference, the Bitcoin halving is expected to occur on the 20th of April. History suggests that BTC will rally significantly into this milestone, but could see a correction in the subsequent weeks. Funnily enough, the cumulative inflows into the spot Bitcoin ETFs appear to forecast an enormous BTC rally. As you can see, it appears that these cumulative inflows are painting a bull flag. Now, some would argue that TA doesn't apply to these flows, but the thing is that it matches perfectly with what's on the charts. If you zoom out to the weekly chart for BTC, you'll notice that its price likewise appears to be painting a bull flag. This is a good sign given that last week it was looking more like a shooting star, a reversal pattern. In any case, BTC could rally as high as 100k if this bull flag plays out, which would be crazy. At the same time, though, it would make sense from a historical perspective. It would confirm the breakout we're currently seeing on the monthly chart, the same breakout BTC saw in late 2020. This is significant because it suggests that crypto could be in something called a left-translated cycle. For those unfamiliar, the crypto market follows a 4-year cycle, which consists of 1 to 2 years of bull market and 2 to 3 years of bear market, depending on your definition. Typically, BTC hits its top towards the end of the 1 to 2 year bull period. In this case, though, it's possible that the BTC top could come much sooner. As cycle analysts like Bob Lucas have pointed out, a BTC top happening much sooner could mean that it will be much lower than many are expecting. Moreover, it could also mean that the crypto bear market will last much longer than it has historically. This would not be ideal, to say the least. Now, ideally, the crypto market should experience a correction to allow it to reset so that it can hit even higher highs like it has in previous cycles. Again, it's possible that this will happen after the Bitcoin halving. If it doesn't, then BTC and the rest of the crypto market could well be in a left-translated cycle. And if you're planning on trading either outcome, be sure to check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and sign-up bonuses of up to $60,000 on the best crypto exchanges. These deals are only available for our viewers and they won't be around forever, so take advantage of them while they last by checking out the Coin Bureau deals page in the description. Now, unfortunately, April is not looking nearly as bullish for ETH, at least according to the charts. To be fair, ETH's weekly chart does look like it could also be painting a bull flag, but even if it plays out, the target may not be higher than around 5k. That would still be an impressive rally, objectively speaking. However, when you look at ETH's strength relative to BTC, you realize that things are looking worse by the day. As many people on crypto Twitter have noted, ETH looks like it's about to completely break down against BTC, though some would say that all the ETH FUD is a classic bottom signal. Regardless, if you watched our recent video about whether ETH is a security, you'll know that the SEC certainly seems to think so. This means there is a good chance that its ongoing investigation could turn into some kind of enforcement action. The only question maybe is when? Nobody knows the answer. This hasn't, however, stopped asset managers from doubling down on a spot Ethereum ETF approval, with Bitwise being the latest to throw its hat into the ring. Meanwhile, Fidelity has updated its application to include staking. Now, it stands to reason that they wouldn't go through the effort of filing if there was zero chance of approval. And, believe it or not, but BlackRock's CEO Larry Fink believes that a spot Ethereum ETF could be approved even if the SEC sues Ethereum and claims that ETH is a security. This could either be a sign that he knows something that we don't, or perhaps a sign that he doesn't know what he's talking about. You decide. Anyways, while everyone's been speculating on the possibility of a spot Ethereum ETF approval, some speculators have taken things to the next level by putting inscriptions on Ethereum's blobs. Without getting too technical, blobs are basically chunks of data that are supposed to be used by Layer 2s. Notably, these blobs are supposed to make Layer 2s faster and cheaper. The problem is that some degens have found a way of putting Bitcoin-like inscriptions into these blobs, filling them up and causing transaction fees to spike. By the way, if you don't understand inscriptions, check out the link in the description. All will be revealed. Now, what's wild is that the activity on Ethereum's Layer 2s alone was apparently enough to cause these congestion issues and fee spikes. This was noted by Ethereum creator Vitalik Buterin in a recent blog post where he called on Ethereum's Layer 2s to increase their internal scalability. What's interesting is that one of the solutions Vitalik proposed was parallelized execution. As the term suggests, this involves processing transactions in parallel, and it's interesting because there's only a handful of cryptos that currently have this ability. You can look those up in your own time. Speaking of which, the biggest issue facing Ethereum's Layer 2s is arguably not scalability, but interoperability. In plain English, each Ethereum Layer 2 is effectively operating as its own blockchain. There needs to be a way to increase the interaction between these chains without constant bridging. A failure to do so means a fragmentation in liquidity, which, in plain English, means that the money locked on each of Ethereum's Layer 2s is essentially isolated. This can be clearly seen on sites that track the total value locked on Ethereum's Layer 2s, like L2Beat, where a few Layer 2s currently have most of the liquidity. Ethereum's inability to address the issue of fragmented liquidity is probably why Solana has been the most popular blockchain for Memecoins as of late. Obviously, there have been a few exceptions, with Coinbase's Base being the most notable, it being, in fact, the reason for the aforementioned congestion. The popularity of Coinbase's Base is not surprising, given that it's very easy for Coinbase users to bridge their assets between the Layer 2 and the exchange. The catch, though, is that this requires KYC, and there have been screenshots circulating of certain Base transactions failing due to a lack of KYC compliance. It goes without saying that this is not a good look, regardless of the nuances involved, and it could result in capital migrating away from Base to another Layer 2 in the coming weeks. The irony there is that most Layer 2s have a single sequencer, meaning they are extremely centralized, and in Base's case, compliant. So, this begs the question of where the speculative capital will flow after it's finished having fun on Base. The answer lies in the reason why Base got so popular to begin with: accessibility. Chances are that the next Layer 2 to see traction will be the one that's the easiest for users to ramp onto and off from. From our perspective, it appears Linea is perfectly positioned for this. For those unfamiliar, Linea is the Layer 2 created by Consensus, the largest company in Ethereum's ecosystem. If the name sounds familiar, that's because Consensus also created MetaMask, Ethereum's most popular web wallet. Now consider the following timeline of events. In April last year, MetaMask made it possible to buy crypto directly within the wallet. In July, Consensus launched Linea. And then in September, MetaMask made it possible to sell crypto directly within the wallet and transfer to your bank or to PayPal. And just recently, Linea announced an incentive program that plans to bring billions of dollars to its Layer 2 in April. Any Coin Bureau Club members in the crowd will know exactly which cryptos we're watching on Linea. Now, of course, this all assumes that Solana won't continue to steal the show, which is quite possible. Solana has been the blockchain of choice for Memecoin degens as of late, and that's probably been the biggest contributing factor to Sol's price action. So far, the Memecoin casino continues to stay open all hours. Eventually, though, all of these paper gains will be erased, and anyone who didn't take profits along the way will be left holding worthless tickers. To be clear, this is true regardless of if we're talking about Solana, or Base, or Linea, or any other blockchain. Never forget, folks, that Memecoins are not investments. Now, the catalyst that causes this speculative capital to disappear will probably be a proper crypto market crash, which, as I mentioned earlier, may not come until after the halving at the earliest. Between now and then, the Memecoin mania will likely continue. And here's a pro tip: watch out for halving-related meme coins. Anyway, as fun as it is to speculate on meme coins, it's important to pay attention to all the serious stuff that's going on outside of the cryptoverse. One of the few serious factors that everyone seems to be ignoring is the gradual increase in oil prices, which could have profound effects on, well, everything. That's because roughly 1/3 of all the world's energy comes from oil, and if you include gas, or petrol, which is often a byproduct of oil production, then the number is over 50%. Thankfully, petrol prices have not risen, but their long-term price charts suggest that they could be in for a big reversal. Probably nothing. Whatever the case, the point is that oil is the largest energy source we have, and we need energy for literally everything we do. It should come as no surprise then that an increase in the price of oil almost always leads to an increase in the price of everything else, particularly when oil prices stay elevated. What may come as a surprise, though, is that the concerning creep in oil prices we're seeing may not be due to supply-side factors, but instead to demand-side factors. There are many indicators to suggest that the economy is starting to re-accelerate, not slow down into a recession, as many have been expecting. Now, this is simply because of all the fiscal policy, aka government spending, that's going on. Not sure if you've noticed, but governments around the world are spending tens of billions of dollars on infrastructure projects and military spending. Newsflash, all of these projects require energy, and lots of it. It seems that central banks are finally starting to notice just how much governments have been stimulating, because Federal Reserve Chairman Jerome Powell made some hawkish comments late last week. This was significant because it's the first time that Jerome had been openly hawkish since late last year. In theory, this should have resulted in a crash, and although crypto did dip a little bit, you'd be hard-pressed to find any evidence that Jerome said anything at all with the price action we've seen since. That's because, in practice, the markets are responding to the relentless government stimulus. Now, this is something that we discussed in our video about the man who predicted everything. To bring you up to speed, a financial historian named Russell Napier predicted that the markets could continue to go up regardless of what central banks do. This was years ago, and his prediction keeps coming true. By now, you'll know that's because Russell is aware that it's no longer the central banks that are in control of monetary policy, but governments. Case in point, the Treasury Department will start buying back US government debt in the summer. This will lower interest rates like the Fed's QE programs do. What this means is that stocks and crypto could very well continue to go up only. Russell believes that this will only stop when governments step in and force investors to buy government bonds to keep interest rates suppressed. To do this, investors will have to sell the other assets they hold. Fortunately, though, this is something that won't be happening anytime soon, and it's something that we'll see coming from a mile away. That's because Russell expects this to happen in Japan first. Once it does, investors around the world will realize, in Russell's words, quote, "Oh my God, it's coming here." Food for thought. Now, before I hand you over to Jessica for this week's top performing cryptos, a quick heads up. Coin Bureau has a big announcement coming out later today. This is something that's been cooking for quite a long time, folks, and it is something you don't want to miss. Now, we're going to be announcing it on our Telegram channel, and there's a link in the description if you're not signed up to that already. So, keep a very close eye on Coin Bureau's Telegram today and find out what it is we've been cooking up. Okay, that's quite enough from me. With this week's top performing cryptos, here is Jessica. Jess, take it away.
Thank you, Guy. Well, last week's top performing cryptos were Core, Dog with Hat, Mantle, Pendle, and Bitcoin Cash. Starting with Core, its Core coin appears to have pumped due to the launch of an incentive program that seeks to increase the total value locked on its blockchain. Now, at a first glance, it looks like Core hasn't rallied that much. Upon closer inspection, however, you will notice that its market cap has been recently hitting all-time highs. This suggests that the Core coin has an aggressive vesting schedule that could be suppressing its true price potential. Well, next up, we have Dog with Hat, whose WIF token pumped for no particular reason. Our best guess is that it has to do with the $10 price target set by BitMEX's co-founder Arthur Hayes. Note that you can watch my interview with him using the link in the description. So as silly as it does sound, it looks like WIF could come close to hitting that $10 target. That's because it appears to have painted a long-term bull flag that could take its price up somewhere around the $6 range, possibly even higher. The correction from those levels would definitely be something to watch out for. Similarly to Core, Mantle's MNT token appears to have pumped due to the launch of an incentive program that likewise seeks to increase the total value locked on its blockchain. The difference is that MNT's price action is easier to make sense of. In a similar fashion to WIF, MNT appears to have broken out of a long-term bull flag and could get close to the $2 range before experiencing a correction. Note, this all assumes that BTC will hold steady or keep pumping. As for Pendle, its Pendle token appears to have pumped due to a massive increase in the total value locked in its innovative DeFi protocol. Like WIF and MNT, Pendle appears to have broken out of a massive bull flag. The difference is that it appears to have hit the price target implied by this pattern. So this means that a correction could come sooner than later. And finally, we have Bitcoin Cash, whose BCH coin appears to have pumped due to the upcoming Bitcoin Cash halving, which is scheduled to occur on the 4th of April. As you might have guessed, BCH is also painting a bull flag on the long-term price charts. And in this case, it's still about $100 away from its target at the time of shooting. It could rise as high as $700 in the coming days. And if you want to know which cryptos are pumping and also where you can trade them, be sure to check out the Coin Bureau Telegram channel. The link is in the description below.
And that is all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $60,000 on some of the best exchanges, only for the viewers of this channel.
Also, if you want to pick up some snazzy crypto merch, the Coin Bureau merch store has it all.
You can find the link to those resources and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.